So the question has to be, where's the stock market gonna stop falling? Like, where's the part where buyers are gonna come in again, where they say, hey, that is a good price. Yes, I wanna buy more, stock units. So we have to talk about that. That's the big topic we're gonna talk about. And then I'm also gonna talk about bonds and just the absolute crushing price fall that's going on with bonds this year. We'll talk about that and a lot more. So stick around. All right. Hey, everybody. RC Peck here. So let's get into this. I want to talk about the stock market and I want to talk about the bond market, specifically where buyers will be coming in. So let's do this. Let me pop over and let's start with this. So here's the S&P 500. We have this right here. Basically, it's the only index that is really holding up on the planet. I would call it the US stock market. And actually, why don't I do this? Let me just show the US stock market here as a whole. It looks, I know, very similar to the S&P 500s, but basically it's the only market that was really holding up. And so the question I had was, is the rest of the world going to join the S&P, meaning stabilizing, or is the S&P going to join the rest of the world, or the US stock market going to join the rest of the world? So look, this crack, if you look at the screen here, the break below that support was significant. Right, that was an area where buyers were coming in, and no more buyers. Now, the U.S. is kind of late to the party because if you look at almost every other stock market around the world, they've all been in a very fragile, weak place. This is the European stock market. So I'm looking at the whole kind of Euro. I was going to say Euro continent, but that doesn't really make much sense. Here's Germany right here. You can see what's really concerning is Germany is already below its pre-COVID high. So this is the pre-COVID high for Germany, and it's below it. That's not a good sign. I'll go back to Europe for a second. Europe is, I know, need glasses. Europe is kind of right there with the pre-COVID high. And, Europe needs buyers to come in. I don't think buyers are going to come in right now. Now, the scary thing is really if you are looking at the S&P 500, the pre-COVID high is right there. It's down there. So from a total market fall, that's about 32% from the beginning of the year to get down here. And that's what we could see in the S&P. We could see about a 32% fall in total before we really get buyers coming in. And now remember, buyers are leaving the stock market, buyers are leaving the bond market. The only place money is flowing into is the US dollar and commodities. That's it. It's not even going into the Japanese yen. The Japanese yen was a place of safe haven back in 2008, in 2008, and 2000. No more. It's literally just the US dollar right now and commodities. Those are the only two plays going on right now. So if we look around the world and say, okay, well, where is the pre-COVID high? Well, it's like you look at China right here. There's the pre-COVID high. They're way, way, way below it. So that's kind of a lookout below. And China even tried to prop up their stock market by coming out and saying, we're going to start being friendly to the stock market. Clearly that got them a pop. The Chinese government came out right here and said, we're gonna start to be nice to you guys. And that's all they said. And now things aren't looking good. Here's emerging markets right here, which have been literally a stay away from for about 14 months. They are now making new lows. They are below the pre-COVID highs. So how far they can go, I don't know. But the market's really accelerating to the downside. The NASDAQ, which is it the growth sector? Is it the 21st century place? But it's getting taken out pretty well right now. Here's its pre-COVID high down here, which means that would be a loss of 42% in total. From this double top down here, that would be a loss of 42%. So there could see some big hits coming in for the NASDAQ 100 or the Qs. So definitely markets are weakening. People are moving out of them. They're starting to accelerate how they move out of them. What you're going to want is a strategy, is an approach that actually steps you out, that looks at the price charts, that looks at the market and says, should I be in more? Should I be out more? Really, you want this stepping in and this stepping out process. That's a strategy. Okay, the other thing I want to show is bonds, and we're going to show it through yield. Woohoo, very exciting. So let's just zoom out here to 20 years. This is the yield on the 10-year treasury. So here is kind of the go, no go place at 3%. Now your brain can clearly see this drop. I've talked a lot about the yield on the 10-year treasury bouncing between 1.5 and 3%. It clearly absolutely crashed below 1.5, never made it to zero, came really close. But now it's really, I know today it's above 3%, but what we really need to be watching is, does it get turned back? Does it stabilize here at 3%? This is why I'm bringing up 3% in the 10-year treasury. If it stops at the 3-ish% and does not start really moving higher, that means the bond market crash could be stabilizing, could start to firm up. So that's really where my attention is to see if the 3% can hold. If it can't, then there are even bigger problems for the bond market. Because actually, I could probably zoom out a little bit more. Because basically the bond market, when this price chart goes down, that means the price of bonds is going up. So as this chart goes down, bond prices go higher. And your brain can clearly see like, oh, is the party over? Is this downtrend of yields over? Clearly there was this huge clean out in 2000, but now the price is above that downtrending 40-year glide path. So a couple things. One, is it going to stay above that and start a new trend? And did that new trend start at the beginning of 2000? That's one. And the second is, which I've talked about, is it going to stay above 3% and start moving higher? If it does, that's going to bring more instability into the market, because the bond market, I hear a lot of different numbers, but it's somewhere between 3 and 5 times bigger than the stock market. So more money is in the bond market. And people over the age of 50 have the majority of their money in the bond market. The older they get, the more they're told to have their money in the bond market. So that's going to affect people over the age of 50 the most. But with more instability in the bond market, it's going to have them be pulling their money out of the stock market, which affects everyone. Okay, so let's kind of wrap this up and talk about where this leads. The S&P 500, or the US stock market, is joining the rest of the world and breaking down. It was holding up. It was like the last stock market that wasn't falling. Now there are, and were parts of the US stock market that were already breaking down, but for the most part, the US stock market was holding up. And now it appears like it's joining, or it is joining, the rest of the world. I see a downside target with the S&P down about 32%. The Qs, the NASDAQ 100, I could see them falling as much as 43%. And Europe and Asia and emerging markets and China, they are already way past trouble. And I don't want to say free fall, though emerging markets is in free fall. Probably China is too. But there could be an acceleration into a free fall. So that's one thing. The second thing is really keeping an eye on the bond market. It is accelerating lower, which is quote unquote never supposed to happen, which is really where the big pain is coming for people over the age of 50, right? Because that portion of their portfolio, that 30% or 40% or 50% or 70% that's in bonds, they were taught was never supposed to do what is going on right now. And so that's the area that's actually creating a lot of pain. And then lastly, where is money flowing? It is still going into the US dollar, and only the US dollar, not other currencies. And it is still continuing to go into commodities. Commodities are not only holding up, but going higher. Thanks, guys, for being in my world. Let me know where I got it right. Let me know where I got it wrong. Leave the comments down below. I read them. I respond to them. Oh, one last thing I'll say to you. Money is not flowing into crypto. So everyone who said that it's going to go in an opposite direction, it's actually acting very much like the NASDAQ 100, the Qs. It's acting very, very similar to the growth sector of the stock market. Sorry about throwing that in, but it just popped into my brain. So let me know where I got it right, where I got it wrong. Please like the video. It helps with the algorithms, and subscribe to the channel. That also helps. Thanks for being in my world. I appreciate you, and I will see you on the next video. Okay, bye.